Google stock is now down 5.5% year to date, making it the third worst performing stock in the Magnificent Seven, only beating Tesla and Apple. In this video, I'm going to talk about some of the biggest concerns that investors have with Google, some of the major positives that Google has going forward, and then I'm going to talk about the company's financials and their earning estimates for the future, and talk about whether I think Google is undervalued or not. One of the biggest concerns investors have is that they're nervous about AI disrupting Google's business. They're nervous that tools like ChatGPT, Perplexity, and other LLMs are going to start eating into Google's search traffic. ChatGPT currently has around 800 million weekly users, which is up from just 50 million users in 2023. And looking at Google Trends, you can see how badly ChatGPT is beating Gemini, which is Google's AI. Just to understand how important search ad revenue is for Google, just last year they did over $200 billion in revenue just from search ads. Now another problem is that you have the antitrust lawsuit that is targeting Google's deal with Apple. Google pays Apple about $20 billion a year just to be the default search engine in Safari. And if that deal gets terminated, it could be a huge drop in search traffic from iPhone users. Now I've seen some investors try to spin this as a positive, saying that now they no longer have to pay Apple, but let's be real, it's not just a loss of revenue and traffic, it's also a loss in terms of brand recognition. Most people don't just change their default browser settings. They tap on Safari and search, and automatically Google pops up. It's helped the term "just Google it" become so popular. People don't even think about using other options because they don't even consider that there are other options. If the default spot is no longer Google, they'll lose some brand recognition, and it's likely that iPhone users will just use whatever is in place. Now, to talk about some positives for Google, the first thing is VO3, which is Google's AI video maker. You've probably seen some videos on TikTok of people using it, and it's incredibly powerful and very detailed. It doesn't have most of the neural mistakes that AI tends to have with hands and small features, and as you can see on screen, some of the videos that it's made, it's very powerful. If they can corner this market, it could be a huge potential revenue stream as AI videos are already taking over the internet. Then there's also Waymo, which is Google's self-driving cars. Waymo is now doing over 250,000 paid rides per week in cities like San Francisco and Phoenix, and they've already passed 10 million total paid rides. They've been expanding aggressively into areas like Los Angeles and Austin, and the entire self-driving taxi market is projected to be worth $40 to $50 billion in 2030. And Google has one of the most advanced and tested platforms in the space. Waymo could be a real long-term revenue engine for Google in the future. Okay, now looking at Google's financials, you can see that the revenue has grown from $90 billion in 2016 to $359 billion in the last 12 months. This is incredible growth for a company their size, and they've grown at about a 16% compound annual growth rate. They have very strong gross margins, fluctuating between 53% and 61%, with it currently being about 58%, and their operating margins are also incredibly strong, with the lowest being 22% in 2019 to it being 33% today. And looking at their net income, it's grown from $19 billion in 2016 all the way up to $110 billion in the last 12 months. This is obviously incredible growth, and the margins are amazing for a business this size. I think it's the highest in the Magnificent Seven, besides for maybe NVIDIA. Looking at their balance sheet, Google has one of the best balance sheets you can look at. As you can see, they have $95 billion in cash and a total of $162 billion in current assets, compared to just $130 billion in total liabilities. So overall, they have a very healthy balance sheet, and it's not something to worry about. Now, looking at their cash flow statement, overall, it's good, but there's one big problem I have with it, which is the stock-based compensation. Their stock-based compensation has grown every year, and this year it was about $23 billion. That's a little too high for me, and it definitely eats into their actual free cash flow. Google's CapEx is also now much higher than it was in the past, being $57 billion in the last 12 months, but this is mainly because they've been investing in cloud infrastructure and AI, and I don't mind this increase as it's investing for future growth. Google has also been doing a lot of stock repurchases as they've bought back $61.5 billion in stock in the last 12 months, and they've paid $9.7 billion out in dividends, which equals about a 0.4% dividend yield. Based on the current share price, Google trades at about 19 times earnings and a 4% owner earnings yield. That's very cheap for a company that's expected to grow revenue 10% a year and is likely to become one of the leaders in self-driving taxis and AI. This, combined with Google returning capital to shareholders through buybacks and dividends, makes me believe that Google is the most undervalued stock in the Magnificent Seven.